Good afternoon, everybody. Welcome to our first set of webinars for 2024. I hope everyone's had a great start to the year and getting on the tools again and looking for great investment opportunities. For those of you who don't know me, my name is Jonathan Wu. I am the Chief Investment Specialist and Executive Director at Premium Asia Funds Management. And so today is webinar one, which will be primarily focused on the Asian equities market, as well as our two equity funds, being the Premium Asia Fund, as well as the Premium China Fund. And then on Thursday, same time, which will be 1 p.m. Australian Eastern Daylight Savings Time, we'll be running through emerging market debt, the opportunity set that we see there, as well as the in-depth breakdown of how we're positioned for the Premium Asia Income Fund. So jumping straight into things, obviously this webinar is of general nature only, noting that there are some direct investors on the call today. So if you, we are not making any recommendations within today's webinar, and if you decide to invest, please seek the advice of a licensed financial advisor. So jumping straight into it, what we see here is effectively a breakdown or recap of 2023 equity market returns. And probably what's key to focus on is the left-hand side, which looks at the source of returns. And if we consider the baseline of where equity market returns are derived from, it is ultimately a reflection of confidence. And China, being what I've highlighted in the red box there, is clearly detracting from any type of confidence. So the equities market for the last calendar year, and if we sort of reflect on the Hang Seng Index overall, it is the first time in history that the Hang Seng Index has registered 4 consecutive years of negative performance. And one of the results of that is that it has effectively decimated anyone's thought process of going into China. And it's also the final major economy in the world that has not bounced back post-COVID. Whereas if you reflect most of the other markets, that confidence factor, if we can call it that, which is the gray bar, made up the majority of most equity market returns last year. Not so much driven by fundamentals, but driven by effectively hope. So whether or not this can repeat again, that's obviously a big question. But at the moment, China specifically provides a very good source of medium-term alpha for investors looking to avoid, especially developed market equities. So the 3 key reasons that we're going to go through today, through the course of the next 30 minutes, is why is now the time to invest in Asian and Chinese equities? Number 1, attractive valuations. Number 2, the Fed funds rates have peaked. Now, effectively, if you consider previous cycles, when you see Fed fund rate peaking and therefore it dropping, the actual onset of dropping rates is good for emerging market investments, both equities and bonds together. And so that is something that has historically driven flows back into the region. And if I sort of take an extension to the point around flows in the last 12 months over the calendar year of 2023, when we look at global equity flows, the allocation to China has actually fallen from 6 to 3% on average. And so again, that is a reflection of how the equity market valuations look. Now, number 3, China has now started to roll out a relaxation of policy. It's not policy that we see a lot of. I was in New Zealand a fortnight ago talking to clients, and most of the stimulus measures the Chinese government comes out with, we never hear in Australia or in New Zealand. So things like them relaxing the RRR ratio, which is effectively the policy or the PBOC allowing the major banks in China to release more of their reserves as funding sources into the market. That wasn't reported. Second of all, China dropped its 5-year prime loan rate, which is effectively the closest thing that we would call the RBA cash rate, by 25 basis points to 3.95%. No one saw that reported in Australia at all. And that is the lowest rate since rates were revamped in 2019. Okay, so the policies are coming out. We don't read about it. Now, is it going to be in the same level or magnitude as what we saw during the GFC? Impossible, because the Chinese government has learned that by doing stimulus measures at the rate of 865 billion RMB, it doesn't work, okay? Because it doesn't work not so much that, it provides adrenaline to the economy and things pick up again, but what it then has an offsetting impact is then you then have to work out through the next decade to actually deleverage the economy, which is not something that anyone wants to be in that position. So recapping our team is based out of Hong Kong, managing five and a half, it's around 6 billion US dollars at the moment. We're headquartered in Hong Kong, and our investment team is over 50 men and women, solely focused on finding the best bottom-up ideas. They are still the single and only listed asset management company in Hong Kong, meaning that they obviously have that level of added transparency from the market perspective. And I think the biggest takeaway here is not, the 6,500 company visits we do a year, but it is the style of our investing. And the style of our investing is that we are pragmatic value, right? And pragmatic value effectively means that we don't discount, we don't take out tech companies where, a lot of value managers sort of stick to their knitting, and that's not a good or bad thing. That's just their philosophy. They avoid tech companies because generally you see high PEs. I'm going to give you an example of, a high conviction holding that we have at the moment, which is trading at ridiculously low levels of PEs, especially when you compare against the Western counterparts. So, we are looking for the best value investments for our clients out there. And given where valuations sit, where effectively it is an open plethora for us at the moment. And also, I guess, by extension of that, even though we're based in Hong Kong, we've got, offices in Kuala Lumpur and Singapore and London, Shanghai and Shenzhen. That doesn't take away the fact that, we're just a China manager. We're definitely not. In our Asia fund at the moment, the highest allocation geographically is Korea. And I'm going to spend a little bit of time talking about Korea because there are some movements, especially around corporate governance, that I think is quite an interesting thing to share, which reflects our view. So I said we're pragmatic value. We're looking for the 3 Rs, right business run by the right people at the right price. And all our ideas come from bottom-up stock picking. Proof is ultimately in the pudding. And as you see here, our Asia ex-Japan equities fund was launched in 2009. And one of the outcomes of that is that we've significantly outperformed the benchmark after fees. All these figures are after fees, and we've also outperformed the incumbent and the largest Asian equity manager in Australia and New Zealand. So we have provided that consistency in terms of returns for investors over the last 15 years. We also have a very, very competitive fee rate of 133 basis points and no performance fee. If you sort of then look at, a lot of fund managers are sort of expressing their returns in terms of, the time, weighted of money, as opposed to just being invested over, a long term, and therefore you get a total sum of returns. You can see that in our peer group, which does get larger and larger as years pass by, and there are 22 funds now across the Morningstar Asian equity peer group. We have been consistently first quartile. Now, for the year to date, we are second quartile. These are figures ending January. Obviously, that's a month's worth of performance, so there's not too much to comment there. Our 3-year annualized return, putting us into the second quartile, is solely a reflection of our overweight to Chinese equities, which has been admittedly disappointing for the last 3 years, during especially COVID and obviously coming out of COVID. But we've provided the consistent outcome of returns for clients over a very, very long time. And that alpha after fees above bench is around 240 basis points per annum after fees. So as I mentioned, China is the last major economy in the world to not have come out of its COVID, I guess, malaise. And we all hoped at the beginning of 2023 calendar year that would happen, and it didn't. And it was effectively hamstrung, even arguably till today, by the property market. Nothing else, the property market, right? Because at the end of the day, you consider the drivers behind equity market returns, as I said, is around confidence. And when you don't have confidence in the property market, which historically has been a contributor to GDP growth and a key driver of economic wealth generation by the upper echelons of the Chinese public, that then obviously has a flow-on impact to spending. in the same way in Western markets like ours, where you have house prices falling, it does have a direct correlation to drops in retail sales, discretionary spending, so on and so forth. Now, in the China situation, because of the fact that the government has taken a heavy-handed approach to effectively restructure the property market for long-term sustainability, where housing and putting people in houses is the priority, and not to allow people to simply speculate on rising prices of property, then that is where that has led to this confidence issue. I'm going to spend a little bit more time on Thursday talking about the property market, but I will sort of come back to it shortly in this presentation too. In terms of trigger points, we have been talking from late last year onwards around this concept of the third plenum. So, for those of you that understand the way that the Chinese political cycle works, it is effectively a 5-year term for a president in which there are 7 major meetings split across what we call plenums. And it starts with the National People's Congress. And what you see here on this chart is effectively mapping out the last 5 market cycles and showing the 5 major Chinese equity indices and what the equity market returns are during each plenum. And what is by far the clearest catalyst is that you can see that from the third plenum onwards, and generally if you sort of by extension the third to the end of the 5th plenum, that is where you see most equity market returns derived within the political cycle of China. And we have not had the third plenum yet. The third plenum was supposed to happen late last year. We now suspect it should happen by the end of the first quarter of 2024, which is obviously sometime in the next 25 days. The government hasn't provided guidance on that. Our belief is that at the moment, there's a number of ministers that is currently being reworked by President Xi in terms of repositioning their futures, as well as the fact that President Xi around 4 weeks ago actually switched out the chairman of the CSRC, or the effective, the equivalent of ASIC or the American SEC, with a very firm focus on revitalizing the capital markets. And what we mean by revitalizing the capital markets is things like restrictions on short selling. Because short selling obviously has been an issue, and there has been a hedge fund that's been caught up in that in terms of government or SEC investigations into effectively illegal market movements. And so the government is very focused on revitalizing capital markets because the equity market is simply very, very, very much in the doldrums. For those of you that might be a bit auspicious as well, you may know that this is in our lunar calendar year. For us Chinese people, it is the year of the dragon. If we look at the past 4 cycles of dragon, so there are 12 animals in the lunar calendar, every year in the last 4 cycles, where it's been the year of the dragon, the first day after the market reopens, after Chinese New Year, the Hang Seng Index is up, and then it ends the year up as well. So again, that's a little bit auspicious for those of you that believe in those things like that. But again, refocusing everyone back on the investment case, the third plenum is the key determinator, I guess, for the economic cycle and sets a scene for equity market returns. What is also very powerful that is yet to unleash and hence not reflected in equity market valuations, not reflected in discretionary sales, not reflected in a lot of consumer-driven consumption, is the level of savings. So the level of household savings in China has gotten to a point whereby, because of the impacts of COVID, if we map it out over the last 40 years, the physical level of savings is around 4 trillion RMB. And that is, if we do a line of best fit over the last 40 years, it is about 28% above the line of best fit, right? Or 28% above trend, depending how you want to look at it, right? So everyone's really cautious, but everyone's is absolutely loaded to the gills in cash. It's whether or not, right, they are willing to spend it. And at the same time, the government is cutting interest rates. And the leverage or net debt ratios of Chinese enterprises, if you look at POEs, is 17%. It is structurally been lowered during COVID. And even if we look at even the central or federal level SOEs, it's about 35% at the high end, right? Again, if you compare that against a decade ago, you can see that whole deleveraging process happening. You can see that especially with the green line, that massive ramp up started when? GFC, right? And then hence, they've been spending the better part of a decade deleveraging. They do not want to be in the same position again. So the corporate sector, household sector, incredibly healthy, just no one is spending. Not no one is spending, but no one is spending as strongly as it could be. And so, despite everything that I've just said, one of the key things, though, is that you would then feel that I've led you to believe that there is no consumption in China, that we've got exports, we've got investment, but the consumption's not there. Well, not really, because if you consider the breakdown of Chinese GDP growth over the last decade, you see that consumption, which is a grey part of the bar, has been a large contributor. What is the other surprising point to also look at the makeup of Chinese GDP growth is that net exports hasn't been a particularly large contributor, let alone a detractor in 4 of the last 10 years, right? And when you sort of compare that and contrast that against the previous 20 years, it was a much different story back to 1990. Right? And despite all the woes in the property market, developers are still being funded. As I said, there has been 8,500 developers that the government late last year announced as part of a whitelist program. And that whitelist program is effectively the process of the government bailing out developments as opposed to developers, because they're two very different sides of the coin. The developers, if you bail them out, they go back to their old ways, which was unsustainable, causes too much excess in the system with regards to people speculating and prices getting out of control. Whereas if you're bailing out developments, you're ensuring the people that have bought off the plan properties get delivered those properties. There is a severe inventory buildup in the system, and there's been a lot of analysis done around what that level is. If you take into account land banking, if you take into account, dormant sites. But effectively, if I summarize it all up, the level of inventory at the moment sitting in the system based on the last sort of 2 years consumption patterns will take around 3.5 years to absorb. That's the level of inventory that's in the system at the moment. And so that's why we say Chinese property will be a slow grind, right, as a sector. Because when you come out of a system over the last 30 years where you see the growth of property prices and volume just keep getting stronger and stronger, that's embedded in the psyche. That's no different to Australia and New Zealand, where we all believe the only way to get rich is to buy property, right? If you don't have an advisor, the only way to get rich is keep buying residential property. And now that psyche has been completely turned on its head, right? Which has had all those then linger effects that I talked about before. So the valuations that you're buying Chinese equities on, if you take the highest P, it's 10 times. And if you take the lowest P, which you take out Tencent and Alibaba and A-shares, you get to about 5.7 times. But regardless of that, you take it against the 10-year average, it is very low. But more than that, there have been times where it's higher than the 10-year average. There's nothing wrong with that. But has the market been at that point? Yes, it has, which you can see here. Now, the thing is, if you then contrast that against US equities, we're not saying that buying US equities, you're not going to make money going forward, right? US equities was expensive 12 months ago, but there is no margin for error to buy US equities. Absolutely zero, which is reflected by the equity risk premium that you see on the right-hand side, right? Whereas Chinese equities is a low-hanging fruit, right? And what we're saying is that if you can get an exposure for your clients of 5% into China, Asia is probably 10%, would be reasonable, then that gives you a pretty good base starting point, which you'll see reflected in the Ps of our actual underlying portfolios. Over the last 6 months, we have decreased our exposure to Taiwan. Again, this is probably a good way to illustrate our investment process at work and deployment of your client's capital at work versus what the macro side shows, because the macro side is very strong. We're coming out of the bottoming of the cycle of the chip and therefore the consumer cycle. Um, and TSMC still remains one of our highest conviction holdings, but we've reduced our holdings overall simply because of the fact that valuations aren't cheap. Valuations are now just under sort of US equities, somewhere between US and Australian equities, and therefore, as a pragmatic value manager, it had a very, very good run throughout 2023, as you can see here, and hence we're taking our foot off the brake. We still have a large holding in Taiwan, but it's now no longer the largest geographical holding for us. Because I do want to talk about Korea. Now, Korea is a market that is so cheap that 70% of the Kospi is trading at a price to book of under 1. Um, Now, a lot of people have avoided investing in Korea because of corporate governance issues. You may have heard of this concept called chaebols, and chaebols are effectively these large family conglomerates like Kia, like Samsung, which effectively they're not minority shareholder friendly. And to give you an example of that, the chairman of Samsung late last year avoided going to jail because, and I'd like everyone to listen quite carefully to this, is that because the chairman was acting in the best interest of the company, but wasn't acting in the best interest of shareholders. Now, there are certain situations where you see that shareholders' interests and company interests are not aligned. It's not common, but it can happen. And because of the corporate governance regulatory environment in Korea, if you act in the best interest of the company, you can't be sued. In Australia, for example, you sue a company director. In Korea, you sue a company, and then the company then makes a choice of whether or not it sues the director of the company. Okay. So that's one of the things is a couple of these chairmen are actually very, very old and will pass away in the not too distant future. And a lot of these chaebols, their next generation are actually far more minority shareholder friendly. And that should lead to some corporate governance changes. And what I mean by that is if I sort of jump forward for a sec and look at one of our holdings in the Asia Fund, which is Kia. And both Kia and Hyundai are great buys at the moment, by the way. Is that they're trading at a PE of around 4 to 5 times. And Kia has already announced share buyback schemes. And so they're doing things in the background to make the corporate governance side of the company very, very strong. Because what's happening at the operational level of these businesses is they're incredibly strong, but people don't trust the corporate governance. Now, you might be thinking, I've never heard of this before, because everyone focuses on lack of corporate governance in a place like China. But Korea actually is even a bigger culprit because of the combination of chaebols as well as the combination of preference shares. Preference shares being you having no voting rights in the system, but you have a preference to the dividend payments that are coming through. And in the case of Kia, one of the things that we're seeing is that with the growth of EV vehicles, and obviously there's recently a bit of shine come off that, we've been also focused on trying to find businesses that can defend against a Trump return to power in the US at the end of the year with regards to tariffs. Because we are trying to avoid companies that do not have alternative strategies when it comes to United States exports. Kia does. It's actually built a plant in the United States, which will avoid the tariffs. And it's one of the rare factories that is actually purpose-built for both BEVs, being battery electric vehicles, so fully electric, as well as ICE, or internal combustion engines. And in actual fact, Kia has a higher margin on ICE cars at about 13% versus 10% for BEVs. And so from that perspective, a company like Kia in our portfolio as one of our top 10 holdings is a reflection of that corporate governance play, but also operationally strong company. The other big benefit, before I spend the last couple of minutes on portfolios, is that the correlation of exposing your clients' portfolios to us has got very little to do with the rest of the equity markets globally, right? So if we benchmark ourselves across all our data points for over the last decade, you can see that a correlation against other indices, XEM, is very low, with the highest one being MSCI All Country World X Australia at about 0.46. Right, so there's diversification benefits, and we know that most investors do not have a bespoke allocation to Asia. As was mentioned, Korea is our largest holding, followed by Hong Kong and Taiwan. This is very different to 6 months ago when we had more in Taiwan. Again, is a reflection of valuations. We are not uncomfortable with the investment thesis. We are uncomfortable with valuation at this point in the cycle. But as you can see here, the cash levels is because of we onboarded a new client. So there was extra cash in the portfolio, but that's not a reflection of we don't have ideas to deploy into. That was just an end of month investment by a client. And then you can see that in terms of our portfolio, you can see it's sort of quite skewed towards new generation, right? New generation sectors. But the end game of that is that the P of the fund, even with so much in new generation, is 8.2 times with a price to book of 1. It is an incredibly attractive story from how we're positioning the portfolio and the names within, as you can see here. It is not just a Chinese exposure. Now, for those of you that are still interested in a pure Chinese exposure, it's our longest existing fund. It's coming up to its 20th anniversary very soon. And it's been a disappointing performer, as you can see, very, very different to our Asia fund. Because, over the 3 years for our Asia fund, we've done -4. 5 years is +6 per annum. Whereas if you look at China, it's been -15 for 3 years and -3 per annum for 5 years. Again, we've outperformed our relative benchmark. The issue has been sentiment. And what you can see here is that with regards to the China fund itself, we are more skewed towards the consumer side of the market. And why? As I said before, the corporates are ready, the consumer is ready financially, but there hasn't been a trigger point yet. So we're waiting for that trigger point. And you can buy this fund at a P of 6.3 versus 8 and a price to book of 0.8 with a dividend yield of 5.2. We're talking about things like China Telecom and China Mobile that are currently paying dividend yields of over 8%. That's how strong these companies are, and that is how beaten down their valuations are. And so Tencent, if I look at a China example, they had a bit of a blip late last year when the government announced, which was, if you can see my hand here, that's circling this point here, on Christmas Eve, the government came out and said, we are restricting the ability of microtransactions on games. So, the ones where, you can't pass a level on Candy Crush, you pay $1 and you get past that level. So the government had started putting restrictions in place. Tencent obviously has a large portion of their revenue coming from gaming. That has been resolved. Their latest game is called Loyalty of Kings or something like that, has been an absolute massive success. And you can buy this company at a P of around 14 times. If you take X cash, it's about 11.5. It's incredibly attractive for what it's currently trading at. So as I said, the reason to invest, attractive valuations, Fed fund rates have peaked, which is good for emerging markets as Fed fund rates fall, and China's relaxation of policy coupled with the upcoming third plenum provides a opportunity for you to start your research to make an allocation back into China and Asian equities. As I said, here are our contact details for those of you wherever you are based. A copy of this presentation will be emailed out to you, so feel free to share it with your clients and take out any slides that are useful. Please let us know if you have any questions. I haven't seen any questions come up in today's panel. But for those of you that are interested in the Asian Income Fund and emerging market debt more broadly, we'll be having our webinar at 1 p.m. Australian Eastern Daylight Saving Time on Thursday. So with that, I'll close it off. I'm just a 1 minute over, and I wish everyone a great afternoon. Thank you.